Today, I'm going to guide you through some fascinating economic ways on how the European Central Bank ensures price stability for producers and consumers across the euro area.
This is Marty. He's an average consumer in Marty land who loves to eat bread, chocolate, and turkey on his birthday dinners. When Marty goes grocery shopping, he buys 7 loaves of bread, 9 bars of chocolate, and 2 turkeys for a total price of €100. This is Marty's consumer basket, which is what Marty spends his money on. On his next birthday, Marty goes to buy the exact same groceries, except the price has risen from €100 to €800. On his next birthday, Marty goes to buy the same groceries again, and now a price of €6,400. And the cycle of price rising goes on and on. Now, why does this rise in prices happen? And more importantly, how can this rise in prices be prevented and stopped?
Inflation is defined as a persistent increase in prices and the fall in the purchasing value of money, meaning that although prices rise, the value that your money has in the economy, otherwise known as your purchasing power, decreases. Inflation is usually measured annually by governments as a percentage of how much the average price will increase or decrease on an annual basis. In Venezuela, the current inflation rate is over 700%, meaning that currently general prices in the Venezuelan economy are rising at an average 700%, although some goods and services are rising below or above that percentage. As a result of this, the high inflation rate has brought lower standards of living, an increase in poverty, and an overall collapse to the Venezuelan economy, including a 191,000 bolivars to $1 exchange rate.
Now, how does the ECB ensure stable prices?
The ECB's main objective regarding price stability is to keep the inflation rate close to or below 2% in order to ensure stable prices. This means that, on average, the consumer basket of goods increases by around 2% per year.
The ECB can ensure price stability by using monetary policy instruments that can influence interest rates, which is the cost of borrowing money, in the euro area. When there is a risk of inflation in the economy, the euro area can raise interest rates. When interest rates are higher, fewer loans are taken out, and thus less money is put into circulation, and the demand for goods and services in the economy decreases.
This means since the cost of borrowing money is higher, less money is taken out from banks, and thus demand for spending decreases. Due to our good old law of supply and demand, lower demand forces producers to reduce the price, since they need to make profit, and thus the inflation rate decreases. This is good, as it can help avoid bank runs, whereby the bank doesn't have enough money to lend to customers, and can also help strengthen the currency. If the inflation rate is less than zero, this is called deflation. When periods of deflation occur, consumers are less willing to purchase products, as they will choose to postpone their spendings until goods and service prices are at their lowest. This puts economic growth in a death spiral. Prices are decreasing, and no one is buying, so the sellers keep on lowering the price. But consumers keep on waiting for the price to be lowered again, and this goes on continuously.
Therefore, when there is a risk of deflation, the ECB will lower interest rates. As a result of this, more money is borrowed, put into circulation, and demand for goods increases. This will help increase consumer spending in the economy, which helps firms increase total revenue, hire more workers, and can therefore put the economy back on track and towards the goal of 2% rate of inflation.
This is why we need efficient central banks that can analyze these complex economic issues and make conscious decisions to hopefully restore economic growth, which leads us to a better, happier, and more prosperous life. Thanks for watching.